Good morning. First of all, a big thank you to all of you for being here today and being able to share with you this Capital Markets Day. I think it's been a long time since the last time we were able to organize this kind of meetings. But a lot has been going on in the world in recent years. Every year something has been happening that was far more important, that put the focus of capital markets somewhere else, in what's going on in the world, very far away of the individual performance of companies. And it was difficult to establish a relationship between any company and the markets. The markets had other things to worry about, like in couples that are about to divorce, they were saying it's not you, it's me, the one that has a problem. So that make it difficult to find the time to discuss about how a company is doing, what they are thinking about the future. But we were wishing that this day could come, and I think that's the time, and we are so pleased to have this opportunity to share with you where Colonial is and where Colonial is going to go in the future. I think it's a great opportunity to talk, because there's always this need to go beyond what's happening in the short term and share openly in an open discussion what are our expectations and wishes and plans for the midterm or for the future, to have the opportunity to discuss at an industrial level, let's put it this way, and not so much at a financial level, to discuss about mid to long term as opposed to a short term view. I think it's a great opportunity, and that's why we are so pleased to have this opportunity today, to be able to share where Colonial is and will be with you in this beautiful place. I am conflicted about it, but I think it's a fantastic place. It's magnum. It's a very good example of our view about the world of offices. You will see today how much we believe, how high is our conviction of a bright future for a certain way of approaching the office world. And it's not about office, it's about experience. It's about providing the right place to be for those companies who really are concerned about talent attraction, about having the best place to take care of the best intangibles of a company, which is the corporate culture, the talent attraction, the talent retention. This is a magnificent place. I hope you will be able to enjoy it before, after, where you can see the kind of experience we want to provide for the people that are joining us in this building. What's the plan for today? That's on the agenda. We are going through the introduction and the welcome. We will devote a few minutes with me about the investment case of Colonial. We will go then more in depth about our operational business model, and then we'll have a coffee break. Afterwards, with Carmina, we'll discuss about financials and, more importantly, capital allocation framework. What's the discipline, the framework, where we develop our strategy in order to later on have a discussion with Carlos about the strategic plan and value drivers. And finally, I will go through some remarks about our strategic view about the future and to what extent we believe that Colonial represents an unparalleled opportunity in the European prime office. With me, I have the pleasure of having Carmina, as usual, Chief Corporate Officer, Juanma Ortega, Chief Investment Officer, Carlos Cromer, Chief Corporate Development Officer, and Alex Septon, Directrice des Investissements, SFL, I hope my French is good enough, who will be with us, plus all the investor relations team that I would like to take the opportunity to thank them for the big work they've been doing in preparing this. Also, I would like to thank all of the people that is supporting in the organization of this event, and all the people in Spain and in France. The French team is here. Welcome also. And I also would like to thank some of you, some of the investors and analysts that are following us for many years, that are also have been providing us with insights on what's the best use of our time in this opportunity today. So a big thank you to all of you. What are the objectives for today? In a way, what I would like for you to remember about today's meeting. What are the takeaways? A few sentences. I would like that you achieve the conviction that Colonial represents a unique opportunity to play the European urban transformation growth cycle. In other words, that Colonial is a really strong investment case proposition. It's a strong company and different from others. You know that one of the struggles we have in this sector, the office sector, is to say and to show and to prove that A and B are different. In fact, we would like that you achieve the conviction that Colonial is different and better. So that could be objective number one. Why? Because of the positioning of Colonial in the prime asset world, which offers a clear path to value creation. So, clear positioning of Colonial and clear path going forward in our strategy. Basically, two things: that there is a polarization game that has already happened in this world of office business, and that Colonial is a winner in this polarization game. That would be one of our objectives to share with you. And because of that, that our platform has a significant embedded growth to be unlocked in the next 3 years. A specific, well-supported, not wishful hoping numbers. Specific mid-term numbers that prove that the growth expected for this company in the midterm is relevant. And again, if you allow me, that we all always and also can be aware that this growth is not just happening now. It's not that we just discover now that Colonial is going to grow in the next 3 years. Also, to remember to what extent this has already happened, and there is quite a lot of evidence and track record of growth if you look at the past. The next objective is also to share with you that our strategy is anchored in a strong capital allocation framework. So it's not a simplistic view about growth, what is in our minds. It's a clear framework of capital allocation with discipline attached to it. And within this capital allocation framework, there is a fantastic growth expectation. But for us, it's as important to share with you how beautiful our expectations are of our growth, as it is to share with you to what extent this is happening within a framework of capital allocation discipline. And as a result of this, that Colonial is offering a strong proposition of shareholder value creation with solid short-term value drivers. Specific mid-term goals, that should be one of the takeaways of this meeting, and a sound equilibrium between growth and solid capital allocation and capital discipline base case. That would be more or less the takeaways that we would like for today. I will start with section 1, which is about the investment case. Where is Colonial? What is our view of the world, of real estate, of our sector? How do we see ourselves within this world? First, the obvious starting point that all of you know so well, and probably no need to go through this. The view about Colonial as simple, strong, and better platform. Simple. Those of you who follow many companies, I guess you will not find many that can be so easily understood in a limited time period. It's about 12 billion in France and Spain, and because the strategy has been so clear for many years, the result is, well, what are we talking about? We are talking about a portfolio of 12 billion, where all of it is prime. Most of it is core, and all of it is at a real top of ESG compliant. No? And that's what I say humbly, strong, simple, and better, because I cannot think of many other investment cases, many other companies that have the same average quality in its portfolio. We always use this picture. We always use this picture because it helps to understand. We always use this picture when you go on roadshows. Many of you know, also with the numbers of occupancy, 100, 100, 100, 100, almost everywhere. We are in thriving places. We are in the best potential locations in in Paris, in Madrid, and in Barcelona. And one of the other messages I would like to insist is not only about places, it's also about clients, no? With the best clients, with the big names that are walking alongside with us, no? And that's as important as the places themselves. No? Let me first go through some remarks about our view of what's going on in the office market before talking about where Colonial is today within this prime office market world. No? What's going on in the world? No? And I would like to go backwards a little bit to have a wider perspective and just to share a very simple thought. No? The simple thought is about despite what's going on in the world, cities are thriving. Cities are expanding, are attracting, are the place to be, are where all the future about talent, about jobs, about innovation, about population, it's where things are happening. We don't have to forget the underlying trend of urbanization that is happening on a regular basis. No? And it's differential. We don't have to forget that cities are performing better down countries, and that mega urban trend is consistently happening across Europe and consistently happening across time. And this is the very basic of our strength. Before talking about the office market, cities are thriving. And what's the relationship between this and our world, no? The world of Colonial, the world of the office market? Well, cities are the place where the new mission-critical social infrastructure is provided, no? For companies. No? There's been a lot happening these years, no? And we all know that the office as an asset class has been challenged, no? Because many things happened. But the way we think about it is in a positive way as an opportunity. So COVID started, no? COVID happened a few years ago. And this was a wake-up call for many companies. Many companies, well, all the companies, suddenly realized they had to think about where do they want to work, how do they want to work, if this was important or was not important, And they realized that they had no tools, no know-how. They didn't have anybody in the company that was supposed to take care of this. Maybe the CEO, maybe the CFO, maybe the HR guy, or lady, but no answer was provided. But then everybody was forced to think about it. And the result of this thinking, in our view, was that for many people, they found out that, first of all, for them, it is very important the intangible values of corporate values, of talent retention, of professional careers, of fostering creativity, of working in a way that allows a company to promote its values, that a big part of the success of a company was related to all of these intangible values. And the paradox was that these intangible values were a lot dependent on something very tangible, which is where do you work and how do you work. So there was an explicit relationship with the choice of where and how do you work with the management of all of these key drivers of the future success of the company. And in getting the right answers, people realized that this important decision needed specific answers, and they wanted specific places. They wanted specific places where they were providing to the employees, to the people that work in any company, the right level of experience. Outside the building, inside the building, and that has become key. And I think there is a big conclusion today among many different companies that this really matters. And what is the problem? Well, not the problem. What is the opportunity? That those places where opportunity is happening are not very much. There is a structural scarcity of the right place to be. And this has been clear for the few years that we've been following after COVID. It's happened already before, but now it's becoming even more strategic. And in the meantime, demand is high. So supply is by definition short, but the number of companies that thought this is important for me is higher than the available space that they are looking for. And this is creating a balance between supply and demand that is different in certain places. This is a slide that we use sometimes when we meet investors. We take the example of Paris, that there's a lot of discussion about how Paris is performing, and we always like to highlight, look, are you talking about my Paris or other people's Paris? Because depending on the place where you are, the absorption of supply may take 2 years, 3 years. Depending on where you are, it may take 6 months. Depending on where you are, there are a lot of new supply that's coming that we don't know where take-up is going to be. Depending on where you are, there is no supply no relevant supply in the foreseeable near-term future. And this, let's say, reality, you can extend it to Madrid, you can extend it to Barcelona. So polarization has already happened. I think that's obvious. And what should be the number, the KPI that would prove this theory that polarization has already happened? Well, and that supply and demand have a different balance depending on the submarket you're referring to. Well, it's obviously rental growth, no? And it's obvious that rental growth has shown a very different path, no? Depending on the kind of submarket where you are. Consistently, we as Colonial have been showing above, and we'll see today again, above market rental growth, above inflation rental growth, and the expectation that we have for the next few years is that this path is going to remain. And this polarization game has also meant that the market, the product, is being fragmented more and more from platinum to gold to silver to very politely called bronze kind of places, no? Different submarkets with different range of rents attached to this. And where does Colonial sit in all of this? Well, we've been in this market view for many years, as you know. Many of you know us, and you know that the obsession about the quality of the product, about the positioning on the right place, has been following us in Colonial and SFL for many years. So we have the positioning, which is not so obvious in some of our colleagues. Therefore, we have the track record. It's not that suddenly we find out that that's our way of thinking. We have it on an international way. We have France and Spain with a long track record. And we do it, as we will discuss today, in a proactive way. We are not passive holders, collectionists of buildings. We think a lot about how to enhance the experience of every individual building. No? And as a result, we are the dominant player in key European gateway cities with strong growth perspective in this market. No? We are at the top of property owners in prime CBD in Madrid, in Barcelona, in Paris. By the way, we are the most important owner of the highest level of trophy assets. No, we have 5 out of 9 of the top trophy assets in Paris. No, and this has proved to work nicely in the past. No, our EPS has grown with a CAGR of 19%, 2015, 2020, 8%, 2021, 2025. What was at 12, today is at 34, and the EBITDA has been sustainable, solid, growing. Let me be more specific, and that's why, that's because the way we approach our strategy is a little bit more complex than just to say that we like the high experience prime CBD buildings. We have 3 levels of strategic thinking. We like to own and manage prime CBD operations. So we like to have an important portfolio with the best trophy assets. Here, the key message that probably Juanma and Alexia will explain better than me. The key message is we are proactive managers of everything we own. And most of what we own, either we develop it or either we refurbish it. Second level, we always try to add a second layer of enhancement of our returns with new projects. The Alpha X projects, the X is not about what you may think. It's about number 10. It's because we've done 9 projects before. So it's a long story of going through this. No? And it's a new wave of projects that we are going through. No? And third, it's about thinking a lot about buying and selling and finding new opportunities of value creation for shareholders. No? Maybe the comment for today, because this has been around for a while, is that you will see that the way we are approaching this in the current market conditions is with an additional layer of flexibility. When we talk about Alpha X projects, you'll see that first of all, our strategy is prime CBD, prime CBD, prime CBD. But when there is the window of opportunity of create value through urban transformation, we do it. We always did it. We can provide examples about 10 years ago, the Mandarin in Paris, many examples. We believe that in current market conditions, you have to be more aware of this and be more close to these opportunities. So you will find that sometimes in our capital recycling policy, our strategy is more open to urban transformation because of tactical reasons related to shareholder value creation. And the other comment that probably we will have is about geographies. We believe that since the market has been evolving in a way that it's being transformed in these two sub-markets, the prime and the secondary, the level playing field for developing prime must be wider. You cannot think about a bright future for a big company doing prime by thinking that you will just walk away, you will just walk Champs-Élysées up and down, buying and selling things in just one street. You have to think that you have the capabilities to do what your platform knows how to do in different places. So we'll talk a little bit about the way we apply this philosophy. Quick comments on this investment case view. Well, sorry that we will hammer a little bit on this during the morning, but this has been already proven for a number of years. If you look at the like-for-like gross rental income growth, it's been, number one, consistently above inflation for many years. Many of you will remember that when inflation started, the question for all of us, for the industry was, are you really able to pass through the inflation? Will you do it? Because if not, it's a disaster. But if you do it, it's super important. And in fact, markets behave as if you were not available. And years have gone by, and the spread versus indexation versus inflation has been very important throughout all of the years. So that's message number one. As a result of this, the numbers of like-for-like growth have been remarkable. Look at the 7 and 8 and 6 and 6 in the last 4 years. Which lead us again to a humble remark, which is, and this is happening also with a differential, with a gap versus our peers, which is maybe not because of us, maybe it's because of the sub-market where we are. The other thing about the investment case, which I already started to mention, but we will go through this, because we're doing new things all of the time, and the question is, well, what's the logic of these new things that you are doing? Does this mean that you are revisiting your strategy? What's the framework? And the message we want to pass to you is we always did this. We always, many of you, we have met in many places, in many meetings, road shows, me always saying the same. Very simple balance sheet, 80 to 90% yield income producing trophy assets, 10 to 20% new ventures that enhance our return. This combination is better than a plain vanilla passive owner of trophy assets. That provides better returns without compromising the risk profile of the company. So it's always been like this, and that's why you will see that in our investment thesis there are always new kind of ventures getting into the investment scope of the company, but the overall conclusion is that our focus remains the same. And then this is in a framework of capital recycling. Where do we buy and we sell? I won't go into details. Juanma and Alexia will go much more than me into details, and maybe Carmina too. We've been buying and we've been selling And basically, the message that we'll share with you is that this is done under a very strict framework of capital allocation with a very strong view on capital structure, on what are the things that we can do and what are the things that we will not do. Where do we stand today? And I will finish with this, this initial approach to our investment thesis. In this capital recycling view, currently we are marginally more on divestment mood and deleveraging mood than on the investment mood. That's how we believe we have to manage the cycle. We announced a few months ago a disposal program of $500 million. Juanma will cover this. This is going super well. He will remember to you that everything we've done for many years, all of the several billions we sold, always at NAV or GAV or a premium, again this time, and being executed in very good rhythm, in very good speed. Based on these results of this program, we are envisaging an additional program of divestments that by now, looking at the market, we are seeing around 200 million euros. And that's the disposals. The new investments are more in the range of 200 million. About the 200 million, the investment thesis, it's all about prime. First of all, as a first remark, before any other consideration. So first of all, our mission statement remains the same. Which are the caveats? Well, first of all, we may consider doing different things. Let's not forget, within a framework of capital allocation discipline, but open to things. One is the way cities are evolving in Europe today. Sometimes there are windows of opportunity for higher value creation in a different use. We are not shy about this. I mean, you just walk through some residential here, when on your path towards this meeting. Well, we did it because when we bought this, 100,000 square meters, like 8 years ago or something like that, it was. We thought 100,000 square meters, this part of town, the best use is putting at least 30,000 of residential and the rest office. And we did it. Who did it? Us. We did all of the development. Albert here played a big role in this, we did it, and then about the strategic thinking, the outcome was we sold it. And we sold it at a nice premium, So we are not shy about this. We do it on a regular basis. We did the Mandarin Hotel in Paris just some years ago. We are doing a hospital in Barcelona because a much better use than of traditional office. We are also considering, as we will talk now, a big project of student accommodation in Madrid. So this is extracting maximum value from our platform, from the skills of our platform. And the other remark is this prime can happen in Madrid, can happen in Paris, can happen in other European cities. And we are currently looking at opportunities. We are currently looking at opportunities in Germany. And we are quite advanced in doing something in a German city. Why? Why this? Well, first of all, as I say, it's not about Germany, it's about prime. We want to have a level playing field as a market that is wide enough for us to develop our capabilities. Does this mean that we don't like Madrid, we don't like Paris? No, we like them. There's a picture that somebody told me, look, this picture here you see in the middle, It's about an asset that is not ours. No? Yes, it's true. This is an asset that is in the market as we speak. No? It's, I don't know if maybe you saw it in the press, is Le Bamberger. No? It's a trophy asset project that is in the market as we speak. We look for it. Did we like it? Yes. Did we were ready to invest there? Yes. By the way, this is a 400 million year project with a number of investors that want to come with us. No? So we are allocating a limited amount of our money. No? What happened? Do you remember the Trocadero experience? A trophy asset comes in the market, 12 people queuing for that asset, which is interesting, no? But we may talk about Paris, but that's a good example about the different dynamics that are happening in Paris. We bid for Trocadero too with a number of investors, no, that were supporting us. And that's another remark, because we don't compromise our expected returns. We were expelled and thrown through the window in the early stages of the process, no, which for us was sad. I'm happy at the same time to see the market dynamics. No? Bamberger has been a little bit of the same. We've been thrown through the window quite soon. No? Which shall tell us some remarks or takeaways. So we don't want to invest in Paris, of course. But are we condemned, no, to a future where we are walking Champs-Élysées up or down looking for these kind of things, and when we have one, then there are 15 people surrounding us wanting to chase this at an unreasonable IRRs according to our judgment? Our level playing field has to be wider. No? What is happening in Germany? There is no 12 people, no, for a prime trophy asset, no, in the negotiation. The expected returns adjusted for risk, adjusted for quality, are higher. So why shouldn't we take a look at this? No? And that's what we are doing. No? So these are the dynamics. As I said, more driven by real estate judgment, micro analytics, not so much about macro. If we have to have discussion about macro long-term view of the markets, we can also have a discussion about the future of different geographies in a few years. But I think that only talking to at the level of real estate rationale, it makes a lot of sense. And my final remark is all of this in a framework of being prudent. No? The problem when you do something new, even if it's tiny, it's that people get the impression that we are doing nothing else but this, and that's the company, the new thing that we are doing. We have more, let's say, wider view. You have bring us your confidence in us managing a 12 billion portfolio, and we believe it's wise to devote 200 out of 12 billion to these things. That makes sense because it's within a framework that makes sense. But this doesn't challenge our strategic view, that remains crystal clear what we have to deliver for shareholders in the present and in the future. These are investment theses. Going back to what I mentioned before, the plan now is to walk you through a deeper view of our way of approaching the management of our assets, then a view of the financial background, the capital discipline, and again, this capital allocation framework that is embracing everything to end coming back to our strategy, to our new investments, and to the future that we expect for Colonial. This would be my first presentation. I probably already killed the agenda about timing, but sorry about that. We'll manage it. If not, since I'm the last speaker, I will be the buffer to adapt for everything to take place in the right timing. Thank you. I give the word to Juanma and to Alexia. Thank you.
Thank you, Pera. Welcome everyone here. I think it's a a privilege to see you here in Madnon. As Pera was saying, let me just take 1 minute. When we launched here 8 years ago, it was a massive plot. Some of the investors would say at that time, in the middle of nowhere, they were completely wrong. We're just, as you may notice, 7 minutes away from Atocha high-speed train station. We're so close to Castellana, and we realized this was part of our DNA. And I think you have felt the atmosphere today, just walking through and coming to this auditorium. Everything that is going to be said during this presentation, together with Alexia, is with regards to this DNA. So forgive me if I just repeat some of the message of Vera. Maybe I have the privilege to have this presentation before the coffee break, so I will try to be efficient. And as Vera mentioned before, it's all about the 3 pillars that form our prime business asset class model. And this is within 3 main pillars. The first pillar is with regards to our existing portfolio. Our existing portfolio, we don't buy or we don't hold the assets and that's it. End of the story. It's, I would say, regular work with the operational teams, thinking about how to squeeze the value every day of this asset, how to increase the growth, how to create value. This is what we are devoted to. So, this gives us and enables us to have this pricing power and differentiation effect from other peers. And as it's been disclosed during the first presentation, to achieve over time a strong reversion release spreads. Second pillar, it's with regards to our capability to transform assets from the scratch or through full refurbishments. We've done it, and you will see in a later slide, during many years, and the most important thing, we have harvested and show to the market the returns that we have achieved. And this has led us to have this superior value creation. And the third pillar, it's so important in today's environment, through a very disciplined framework. We don't just take by coincidence decisions. We are doing everything through a smart asset allocation model. We are buying at the same time we are disposing assets. We don't say, during these months we are going to acquire assets. We are doing everything at the same time to create value. And as a result of this strategy, sometimes we are more inclined to deleverage, to be strict and prudent with our capital structure. Others, we want to rely on the cycle, and we want to make the most of the opportunity, as I was mentioning before, in different places where we are sure we could be doing returns in the future to come. So, if we start, and I think it's obvious, it's been said, the value of our portfolio relies on, it's a unique and irreplicable portfolio comprising in excess of 80 amazing, prominent, standalone assets in the 3 cities we are today. You can see here the pictures. Obviously, it's worth the image rather than the words. But and all of these assets have been transformed by Colonial, have been created by Colonial in many different situations, either from the scratch, from a plot in the middle of nowhere, to full refurbishment like Diagonal 530, to the change of a project like it was Velázquez, that it has become the reference in the prime office sector in Madrid. So many different situations. I think this portfolio, as I was mentioning, cannot be replicated. Those landmark assets in these locations where there is a chronic supply shortage. So there is a value behind, and that explains why we are so persistent in trying to get and extract the maximum value of our assets. So It's about location, obviously. It's about being in the prime and CBD areas, but I think we are obsessed, but it's part of our passion to design the best products. And when we come to this, we try to have this driver of our clients. How can we enrich the experience of our client? So that's why you can see here in the screen, we have 3 pillars for the design of our products. We want to foster experience, we want to have efficiency, and through the best environmental standards. So if it comes to experience, you have obviously first factor, location. It's essential in this polarized world. And then that's why, and explain, as we saw before, we are close to 100% located in central CBD and prime locations in Paris, Madrid, and Barcelona. Then we foster the experience of the client through the combination of different areas. This is a great example. You may see later people coming, well, probably today is not a good example because due to the Pope visit to Madrid, everyone has remained at home. We were expecting the city to be a chaos, but so maybe today is not the best example, but I just welcome you to come here, to come back and to see all the employees coming to the food and beverage areas, to use all the co-working spaces, all these services of the auditorium, etc. What are we doing in terms of design? We are trying, and 58% of our properties provides large floor plates that links to efficiency together with the horizontal buildings scheme, and that has made us possible to have this multi-tenant, the risk client base. And it's not about one sector, it's not about companies of one sector, it's about companies of many different high margin sectors. And then when we speak about the environment, you all know we are top ranked and best-in-class sustainability certifications on all the environmental and ESG policy. So maybe now it's worth if you just can tell us about clients.
Thank you, Juan. Good morning, everyone. It's true that this active management approach is probably the result of the quality of our portfolio. You have seen it. It's also maybe the fact that we have internally all the functions to handle it, to promote it, in order to do one thing, to attract and to retain clients. And even if location is clearly still the first criteria for companies, prime offices are no longer just about location. We have talked about many projects. Magnum is a tremendous example. Now companies are willing not just to have places to work. They are willing to look for strategic tools in which every time we design bespoke space in order to, again, meet the needs of the most demanding and sophisticated clients. We have obviously many examples on this slide in all the cities we are invested in, and especially across several sectors. We have amazing clients and very prestigious clients. We can tell about tech companies with Meta and more recently Pinterest. We have also clients in the finance field with, let's say, many of them like, Van Totten or many others. We have also fashion industry with LVMH, Alo in retail, also units, as well as many others, and so on. And the idea is to do this kind of amazing projects every time, and a good illustration and a typical illustration could be Edouard Set, as you're seeing here. Edouard Set is a masterpiece. is really almost a piece of Paris, more than 1 hectare site in the middle of the 9th district, one of the most sought after area both for companies and employees. This is a mixed-use complex, and if we are reminding all the criteria Juan just told us regarding what we are expecting and what our clients are expected, it's a large-scale scheme, more than 54,000 square meters, with large and horizontal and very modern floor plates, even if the architecture is very typical of a Parisian style. It's also mixed use and multi-tenant. We have more than 14 office tenants in this building, creating real traction and vibrancy in this complex. When we are talking about mixed use here, it's about the district, the area, the direct area, but also inside the building. We have obviously prime offices, but also retail mix that creates really vibrancy in the area, as well as a hotel, 2 famous theaters, including the Olympia. We have also residential and living units, also co-living inside. We have a public parking, we have an auditorium, meeting rooms, and also dedicated services to the office clients, from a restaurant to a cafe, as well as a fitness center and a bike park. I have many other examples of this kind of project. I could talk to you about Cloud, about Washington Plaza, and this is the typical kind of product we want to invest in, we want to develop, in order, again, to meet the client's expectation. These buildings are fully occupied with consistently strong rental growth, and this is what we believe is the new trend. Could be in the next few months, AI companies that are looking for this kind of buildings, and we are really trying to do our best to develop and again increase this kind of amazing landmark in our company. And how we do that? We also use our competency to develop with the Alpha X project, and Juan will talk about it right now.
Okay, thank you very much, Alexia. Yes, going through the second pillar. And it's been said at the beginning that we have constantly and consistently contributing to the value of the company with the transformation of projects during the last 15 years. And here you may see 2 generations of projects. It's not about one big project and period, full stop. It's about many, many different projects. This is explaining why we are talking about Alpha X. We are not talking about Alpha 2. And with this regard, we, under our discipline, we are reaching 9 to 10% unlevered IRR returns with capital gain on cost blended basis from 50 to 70%. I would say outstanding and very famous projects within the different cities where we are working, reference that we've been awarded over the years by many different organizations. You are going to visit today, obviously, Magnum. You're going to visit Velázquez. But you can see here how the large scale of the projects, the critical mass. Some of them we have already sold them, and this is linked to the third pillar. Let me just go quickly because we have already spoken about Magnum, and maybe it's just worth having this tour and answering the questions during the tour. But this is what I said before. See at the left-hand side what was the reality of Méndez Álvaro some years ago. What is today? Well, many different institutional investors have come behind us, and they have developed other schemes, residential schemes, EBSA, flex living, retail, hotels. So it was not just, to develop an office property. It was about urban transformation. We have clearly transformed this urban area. The mayor, his team, and the town planning authorities have called us many times. I just remember a week ago they said, look, we want you to be and to have a leading role in designing priority areas of new development in Madrid, because we want more magnums to come to the city. So it's not just one asset, and I think we can say this with many different projects that we have shown you in the past. Obviously, it's not just a design, it's linked with the client attraction that Alexia was mentioning, or if we can attract talent, we attract, obviously, companies. We make employees, they would like to come here, and they are not complaining about coming to the office space, and this is contributing to the benefit of our clients. Here you can see that we have already achieved 88%, but I think the good news is that probably in 2-3 months we will be reaching close to 100%, 97%. Then from underwriting rents, we have exceeded 25%. It has, in the end, it has created, at the beginning this was called a second area within the M30 Ring Road outside the CBD. But today, because the rental performance, brokers want to have Magnum as part of the CBD. So this is a reflection of the urban transformation effect. Then if we move to super prime area, I was saying, like Velázquez. Velázquez has been a super successful project. We started negotiating with the existing tenants. Those tenants were paying 18, 19, 20 euros per square meter per month. So our first objective was to, let's say this way, get rid of those clients, to start with the transformation of the asset. It was complex project, but we did it, and we moved some of those clients to other properties of Colonial, like Discovery. I think the design is you'll see later, it's a state of the art. One of the most attractive terraces within the city, and we have innovated in the sense that the operational team led by Albert, they have include common areas within the gross lettable area of the clients, and they are super happy to pay for those areas because they enjoy those areas, they use those areas. So later we will see this, and Alexa, maybe some great project in France deserve your words.
Thank you. You are probably very familiar with this operation in the middle of the heart of Paris, which is called Louvre Saint-Honoré in-house. This is also a large-scale mixed-use building, more than 45,000 square meters, let's say half office, half retail. If we take a look at the operation, on a value creation standpoint, this is again a tremendous success. You can see on the slide we have a value creation with a multiple of almost 3, which is impressive. The idea is to understand how do we achieve this kind of project. Clearly, it's a middle to long-term view. You have to have a lot of convictions and ambition and discipline. First of all, we pre-let and secured all the retail area by signing a 40-year firm term lease with one of the major luxury brands in the world, which is Cartier, to locate their new foundation, which was previously in the 14th district of Paris. 40 years with 20 mandatories is unique in France. Then we have co-created one of the most sophisticated, innovative, and very highly technical projects designed by one of the most impressive architects, Jean Nouvel. Our team manage all the administrative authorization supported, which is important, by the city of Paris. Then comes the hard part. We had to handle the fact that this project was one of a kind, very unique, very innovative, but we had to take into account all the technical requirements, and we signed at a very early stage a contract with Vinci in order to verify if it was technically feasible, and also to define the right methodology to deploy this kind of project in a very dense environment, because you are in front of the Louvre, the Conseil d'État, the Ministère de la Culture, and so on, which was really tricky. So we probably would have failed at many stages without the help of a unique team as well as unique advisors, clearly. So we delivered this project to Cartier earlier than expected in July 2023 in order to let them do their own works, and the foundation opened to the public in November 2025. The project and the work on this amazing asset is not over. We are now in the new stage, and Eric will be happy to talk about it during the break, to refurbish and reposition all the office to let this amazing building become the primest office building in Paris. We have already signed 7,000 square meters of offices at really high level of rent. There are still a lot of potential to capture in terms of rental growth in this building, but we are already very happy to be the owner of this kind of amazing landmark building in Paris. So we will definitely continue. That doesn't mean we doesn't think about rotation in some points regarding our portfolio, and Juan will talk about it.
Okay, before jumping on the smart asset allocation strategy, just have a look to the midterm EPS main driver through the existing projects. I think we are running out of time. Just a few comments about them. In Spain, we are transforming the former headquarters of Deutsche Telekom in the 22 at prime area for a hospital. In the left-hand side, you can see we have already signed 30 years contract, with 15 years mandatory with one of the main players of the healthcare area. This is in the Bupa group. It's Sanitas. So now we have a very good news because we have been granted with the license. We are progressing with the project. We have signed rents at 29 euros per square meter per month. That is almost 111 increase on the former rents, and 20% above the prime office rents in the area. Secondly, in Spain, to highlight, and it's going to be a reality in 2028, fourth quarter, is the full transformation of the headquarters of IBM. Those headquarters developed in 1986. It was obviously an outdated. It was like a museum. We love it when we inspect it. It was the kind of offices of the 80s, and now it's going through a full reconversion to one of the I think vibrant and promising living concepts within the S30 of Madrid. We have gained buildability around 7,000 square meters. We are going to have an increase of 70% of the existing rents, and we have already met an agreement with one of the main players or operators of the living arena. So maybe a few words about France, Alexia.
Thank you. Regarding France, one other key point of our strategy is also to invest in main gateways in the cities we are invested in, Paris and Madrid, obviously. These two projects are located next to a main transportation hub. Scope is positioned next to Gare de Lyon, It's a major transformation of this previous Natixis headquarters. It will be a best-in-class product, definitely, with high visibility through its new bioclimatic facade, as you can see, with obviously large and modern floor plates and a very defined and designed offer of services. It will be delivered by the end of the year. We are currently in the leasing process. We are targeting an unlevered IRR of 9% and levered IRR of 13%. And we are happy to announce that we have already secured the first contract pre-let yesterday. Condorcet is the same kind of vision, but in a different area. It's next to Gare du Nord, which is an amazing connection to many European cities like London, obviously, Brussels or Amsterdam. This is also a 1 hectare site, an amazing mixed-use urban campus development, which mix offices and residential. We will host student housing accommodation, as well as 22,000 square meters of brand new offices that combines perfectly modernity as well as heritage, meaning that you will find all the design and architecture of the Parisian style city, as well as very flexible and modern floor plates, which will probably allow us to attract a variety of potential targets from tech to AI, as well as media and fashion companies. So the delivery is expected by 2027. We are also targeting 9% unlevered IRR and 13% after leverage. The process of leasing will start in the coming days, but we are very confident about it, as well as the ongoing works that are without any concern on our side.
Okay, so let me just go very quickly. I'm seeing the screen red numbers now. Within the third pillar of our prime business model, it's our capital recycling strategy. What we've just disposed over the year, 3 billion euros of assets disposed. What kind of assets? It's easy for us. All these assets that do not comply with the attributes we would like to develop to squeeze that portfolio that we were saying at the beginning, those assets are no longer in our wishes. So this is our first target. Second one is all those assets located in outskirts or peripheral locations. As a result, you may see here the active strategy of disposing all of these assets over time. Then I will take some time to speak about the recent disposal plan and the new disposal plan. And with regards to the acquisitions, always with this objective of creating value through prime factory, through value-added opportunities. You will never see Colonial coming into the market and buying 3% initial yield property with no upside potential. That is not part of our business objectives. So today, where we are, and linking with what Pera was saying, that we are so disciplined and we are inclined to the deleveraging process. With regards to the first disposal plan of 500 million euros, here it's disclosed that we have already executed 70%. It's wrong. It's not 70%. It's close to 80%. And the reason behind is because we are actively doing further disposals over the last week. And Carlos is not going to be changing the presentation on a daily basis. As an example, unfortunately, I need to leave you because we are closing one transaction today. At 12 o'clock, we are selling one of our granular residential assets in the outskirts of Madrid, worth 20 million euros. Tuesday this week, we signed a commitment for 19 dwellings in Zaragoza, and we have already visibility for commitments of the residential portfolio accounting close to 100 million euros before August. So probably for the first disposal plan of 500 million euros, we will be reaching close to 92-93% before summer. Together with this, it's been announced a potential additional program of 200 million euros. Obviously, this is due to the fact that we are constantly working on new disposals. We have together identified many different situations comprising 7-8 assets where we are having different bilateral conversations with different investors. And let me just reinforce and hammer the message that we always have conversations on appraisal value, and normally with a premium on appraisal value. Is not a bullish talking. You know this because you've seen over time, over the last 15 years. So we could have visibility as well before the year end for these 200 million euros, additional 200 million euros. And then just a few words on the acquisition side from the Science and Innovation acquisition last year. First message is the existing portfolio is going well, is going as expected in the business plan. Many lettings have been accomplished with clients under the Science and Innovation arena, critical infrastructure, stick clients to the real estate properties. And then just Pere already mentioned, so the two projects we are today involved. One is the creation of a leading platform within the M30 Ring Road in Madrid. Madrid, the megatrend is amazing for living. Just to give you an example, I think in the UK, one bed each 8 students. Spain, one bed each 17 students. Inner Madrid, within the M30 Ring Road, it could be even higher. So following the scarcity, following the megatrends, we have progress with a potential creation of a living platform without making any further investment. And lastly, it was what Pere mentioned about different opportunities in gateway cities in Europe with a prime approach where we can find some upside potential, some rental growth in only this kind of assets that we are fully convinced we can extract value in the future. So from us, this has been the description about the business model. I hope you have enjoyed, and let's go for a coffee. Thank you very much.
I don't know if everybody's here in the room. Still people? Yeah? Okay. So I think we can start with the following section. Thank you again for coming. I would like to spend in this almost 20 minutes of my presentation on what we really think is the backbone of what you have seen and what you have heard this morning from Pere and from Alexia and from Juanma. So basically the financial foundations, what underpins the business strategy, and how we manage, you will see how we manage our financial side of the business, and why we believe the framework that we have built give us this, I would say, secure and very high visible and the right direction for the growth that we are going to share today. So I will cover basically 3 things. One would be where we stand financially today. The second thing is how we work and how we envisage the capital allocation framework, and then how this all in it's being translated into the returns as well, of course, and the growth for the total shareholder returns for all of you. Let me start first with a simple observation. So over the last decade, the EBITDA has been growing almost 2 times. The EPS has been growing almost 3 times. And this is not a coincidence. It is a meaningful growth. And as you can see here, that has been this growth keeping the loan to value in the range of 36-40%. So basically, in our track record, always, and I will come later to explain how, basically, we are very focused on combining this binomial of growth and discipline. For us, it's a very important goal to keep in every single decision we take in our company. So growth and discipline can be done jointly with a good strategy and a good balance. So this combination of growth and discipline over the full cycle is what you've seen here. Growing, keeping the metrics on the ratings, and even enhancing the ratings at the level that we would like to be, which is this according S&P BBB+, and according Moody's Baa1. So this is a rating that we need to be focused where we want to be, and the range where we want to be inside when we run our business. So this is not this is deliberately being decided, being and keeping our metrics inside these levels, maintaining the growth strategy, as you know very well. But what is behind this? How we actually think about our balance? First, let me go to the liquidity and let me go to the maturity profile of our debts. I think you know very well how is the maturity of our debt, but the message that I want to share with you is that behind this is a very active liability management. So you have seen what has been very actively in the balance sheet, and you see and you know what is behind our liability management, managing every year, every month, what could be improved, our key metrics in financials, how we can extend at a better conditions, how we can include additional banks. Some of you are here, so thank you for the confidence on Colonial project. And this is what is behind all these metrics, and this is what our teams, some of them here, are working every day. So to enhance and to have the best liability, the best debt. Pedro, our CEO, always tends to say that we have the prime assets, but we would like to have as well the prime debt, no? And the prime, this is how we protect our balance sheet. So the liquidity risk always has been kept at 2 billion, roughly. Today, this liquidity covers almost maturity up to 2029. It's true that today we have a very interesting cost of debt, 1.9. Maturities of 4 years, and improving and enhancing these maturities in this active asset management, and keeping the investment rating in the higher end. But these are solid numbers, it's true. And the question naturally probably you would raise is how confident we are to maintain these solid numbers. And probably one of the key tests to answer this question about having the best debt is the bond market. And the bond market is, we try to look at them as a useful external perspective, and the test, and the nice test, to see if there is a good test for us and for the appetite from the institutional investor of Colonial debt. Over the last, you can see here the 5 years spread. We are now in the lowest range of the spread for our bonds, well below our peers with the same rating. I invite you to compare this spread with other peers with the same rating that we have. But basically, because behind this there is a lot of credibility on the strategy, a lot of visibility on the cash flow, a lot of quality on the cash flow, and this is behind this spread above or better, okay, better in the markets, above our better than our peers. So this is probably that it's a genuine conviction from institutional investors in the underlying credit quality. And this is one of the probably data. It's about the solid investor appetite. It's what we experienced in the recent bond issuance. By the way, green bond issuance. You know that one of the key strategies across our portfolio are to be in the high end of all the green strategies. And we were in the past the first real estate company in Spain issuing green bonds, and all that green bonds, and term loans and revolving facilities, all of them are green debt. So we experienced a very solid investor appetite, reflecting this confidence in the recent issuance of bonds. So basically, we tapped the market last year of 1.8 billion, and we received an appetite, or we received an oversubscription of almost 4.4 times. So this is a demonstration that our paper, our credit metrics are well received from the institutional investors. And as you may see here as well, our group loan to value has been decreased from since 40% to 37%. As well, the EPRA loan to value improved 200 basis points, and the net EBITDA improves as well. I will come later about this trend of deleveraging. But now, probably let me go forward about what is our financial approach. In this section, I have shared now what has been our key financial metrics as of today, but these are not a coincidence. So where we are today, it's as a consequence of thanks to a very disciplined capital allocation and a very disciplined financial framework that we work every day. So at the center of our financial approach is a framework that we have built, and let me explain a little bit this chart, and then I will cover the different parts of this chart. This is very, with an image, how we manage the company, how we approach any single investment, and how we manage the objective of our shareholder return, keeping always the financial discipline. So it's a framework built around three interconnected priorities: capital recycling, financial discipline, and shareholders' remuneration. They are not independent. They are interconnected among them. So each one enables the other one, and discipline recycling of capital funds that you've seen before from my colleagues Alexia and Juanma, new funds, these disposals of funds investing at a better returns, financial discipline preserving the credit metrics, the rating credit metrics, and together we generate this ambition of shareholders' return with a very, solid and predictable cash flow. Let me walk now through each one of the boxes. On the financial discipline, here some of you always talk and ask about what is exactly the metrics that we need to put as an objective on the financial. And we always answer, sorry for that, the same, we say always the same question, which is the reality. So how we approach our financial discipline, this box very important, to keep this binomial, this balance between growth and discipline. So how we approach the financial discipline, it's the same way how the rating agencies approach our credit metrics, our credit rating. And they evaluate, and this is very important, you consider in your approach to Colonial, because it's different than others. They consider the business profile. You've seen before in the initial part of the presentation. What does it mean, business profile? Business profile means high quality assets, unique assets, well located, good collateral, good contracts, good tenants, high occupancy rate, high release spread, and pricing power. This is what it means, the business profile. Because the consequence of this business strong profile gives us a lot of certainty on cash flows. And this is different than others. And you should consider when you approach Colonial in terms of financing metrics. The other, of course, the other vertical, it's the financial profile. As you see, and we share with you in every quarter, strong liquidity position, interesting hedge position, secure interest rate, high visibility on the interest rate for the future. I will come later on details on that. rating, robust policy, financial policy, resilient capital structure. When you go through, as I mentioned before in my previous pages, when you went through the growth that we have devoted and we have delivered during the last decade, always has been with this discipline, financial discipline, in the range of this loan-to-value, in the range and below, with some room with the metrics on the investment grade. What does it mean? That growth and discipline can work together. And this is what it means, financial profile. And then, of course, operational. So we have a track record of solid tenant base. We have a track record of a strong management and governance in all our operations. And all has been, this is the set that the output of these three verticals is the rating. These are what the rating is considered. These are what we consider in any single approach, in any single investment analysis. When we include this analysis in our business plan, always we reshape with these three verticals. Are there, according our business profile, risk, high quality, prime location, release spread, additional returns? We can operate as we have our capacities in place. Then it links the output. It's the rating by investment grade. So why we believe, why we think this strategy? We think that the financial strength is an asset by itself, but how we manage them in terms of metrics that some of you are asking for, and this is probably the page that you would like to see, but I would like to explain this page. You need to consider this page accordingly with the previous one, because isolated this page, it's one part of the equation, and this is not only the equation that the credit metrics and the financial discipline looks like. It's not. But some of you ask for about what takes our target loan-to-value, how it's translating, and here internally, again, for us, the main goal is the investment grade. And what does it mean, investment grade? Metrics, and in that case, we have taken S&P. The S&P loan-to-value between 35–45%. Where we are today, we are below the limits. So we have room to manage any optionality in investment, any volatility in the market. So we are confident of keeping in this range. But what is translating in this range by S&P to what you would like to listen to? Loan-to-value, to EPRA loan-to-value, so to IFRS loan-to-value or to EPRA loan-to-value. So basically, to keep this range 35–45 S&P loan-to-value, it's translated into group loan-to-value maximum 42%. Today we are at 37. Our internal goal being a little bit more conservative at max 40. And at EPRA loan-to-value, the translation of S&P to EPRA loan-to-value, it's maximum 50%. Today we are at 45, and our internal rules are at 45. So these are one part of the equation. These are behind our discipline in combination of what you've seen previously, and these are the boundaries which we are included inside the rating metrics. And we feel comfortable in being inside these metrics, and our business plan, considering the existing market condition, shows the leverage on these metrics around 150 or 200 basis points on the EPRA loan-to-value. So this is a deleveraging trend. Being inside these boundaries, we keep what we want to be in the rating, the maximum or the high end of the investment grade, and we can manage with buffer enough, with room enough, any market volatility and any investment opportunity. And on the net EBITDA, which is the other key metric for us, a company with Colonial, with the quality of of the cash flow, with this predictable cash flow, and this is something with the rating agencies, they feel very, very, very comfortable. The standard stabilized net EBITDA should be in the range of 10 to 12 times. This is the stabilized net EBITDA for a company like Colonial. Where we are today, 15. Why? Because we have a very important part of Project X that you saw before, going in the right direction, and at the end of this Project Alpha, Project X, at the end when these projects will be mature, the business plan reaches 11 times, between 10 and 11 times net EBITDA. Why we are not today? Because we have almost more than 10% of our portfolio not income producing. If you exclude this effect, of course, our stabilized operational part, the first column or the first pillar of the growth, it's 11 times. So this is how we envisage our global financial strategy without having any rating pressure. So the answer about growth, because some of you, I would like to see more deleveraging, I would like to see more disposals, but this plan shows a deleveraging trend according to today's market condition. This plan shows a balance between growth and discipline, so we can deliver growth and keeping discipline. And this is the financial metrics. But how we protect the cost structure? This is also another question that you raise sometimes. First message that we would like to share with you, our debt for the following years will show this profile between fixed cost and hedge. And then will come what is the level of this cost of debt. But thanks to the bond issuance that we have done in place, thanks to the hedging that we have in place actively, this is not a strategy, this is one-shot strategy, this is a permanent strategy to protect our balance sheet, and we have been consistently executed. This is the profile of our debt that will look like for the following years. So mainly up to 2028, mainly 90% average, it's being covered, fixed, and today's with a high visibility on the cost of debt and very, very, very limited, as you see, exposed to the market conditions. What is the reality in terms of cost of debt? It's what you see in the right-hand side of this slide. So the cost of debt that we will have for the following years will be well above market levels. And this is not a coincidence. This is behind our active hedge strategy, our active balance sheet strategy. So we have created a lot of value for you during these years. We have still a lot of value to crystallize in the following years, thanks to this hedging. And this is a real advantage of Colonial to others. There are few players, few peers that they have this position that secures growth coming from the operations, secures a path to growth, a very clear path to growth that I will come later. To give you some additional probably numbers, and I don't want to cover in a lot of details, I'm happy to disclose and to answer any question if you have. But some of you as well, you were asking about how can I have some visibility, how this mark to market or how this value of hedging is being recycled into the P&L. Basically, three main ideas you need to take from this page. We have created a lot of value from the hedge. Since when the rates were negative, we took a very smart position of covering future cost of debt for the future maturities in our bonds. So basically we took almost 3 billion pre-hedge instruments to cover all our debt that will need to be at that moment, would needed to be refinanced in the future. For the following years, 2026 has been already done. 73% of our debt that has been expired this year, 73% has been hedged at 2.4 strike. You can see here what will be in the following issuance, debt maturities, 627, 28, 1,000. What will be the level of hedge and the strike behind this level of hedge? The two final comments. The hedge that we have today, which are booked in our accounts and of course audited, this is 233 million euros. This 233 million euros, it's the hedge, the value that will be allocated in any future maturities of bonds that we are going to be refinanced in the future. So 233 has been allocated, will be allocated 12 million in the issuance 2026, 32 and 2027 and beyond. But how will be this 233 allocated or recycled into the P&L is the ones the bottom line. So the idea you need to take from this page is we have a very predictable cost of debt. We have mark to market a lot of value still to crystallize, 233 million euros still to crystallize in the following years, up to at the very end that all the debt, not 2028, not 2029, not 2030, at the very late, all the debt in place today will be mature. This is the idea of this page, and it will help you probably to modeling what is going on. And this is the consequence of this cost of debt I showed you before, and why we are so, I would say, comfortable about the guidance for this part of that, about the guidance that I am going to share with you. So this is not a meaningful exposed hedge, and what we would like as well, an interesting takeaway, an important takeaway, because for us it's important, this is not a coincidence, this is not a single strategy, this is a permanent strategy to protect, to secure the cost of debt, to assure that the growth comes from the business, okay? And this is not a coincidence, behind this is a real policy, no? Given that financial discipline, I'm going now to the other box, to the other part of this helix retrofitting by themselves. This is the capital recycling, and this is the part of our investment side. We have as well a clear framework. You've seen a clear framework of the capital of the financial discipline, and you will see now, and some examples has been already done. You will see a lot of as well a very clear framework on the financial discipline. We approach any single investment with a very clear hurdle rate, subject if there is core plus investment or value-added investment between 7 and 8.5% if a core investment, or 9-10% if a debt value-added investment. And these are not the hurdle rates that are linked to the macro drivers. These are hurdle rates that are linked, and I think also Pedro mentioned before, they are linked to the micro-driven analysis of any single assets. It means, what does it mean? Location. It means tenant. It means if the asset is under management, we can create value enhancing the operational part of the management, or some light capex to enhance the value of the investment. It's about location and city centers and profile of the scheme. It's about potential release spread. It's how we can recycle this capital to ask for a very interesting capital returns. Why these levels? Because with these levels, we are beating the cost of capital that the market are requesting. And with these hurdle rates, we are creating value for all of you. So the combination of these hurdle rates, being very disciplined on the investments, keeping the framework on the financials I explained before, we secure the growth value for the shareholder remuneration and the value creation, because all these hurdle rates are well above the cost of capital that today's market is requesting for Colonial. And very clear, we filter every single opportunity. If we don't reach these hurdle rates, we are not going to do it. And you should be, I would say, very confident in what we've done, because the track record, I think, we believe that shows this discipline always as well in the investment. And this is how we can maintain the return profile across the cycle, with this room to surface at any market volatilities, and as well to take advantage of any opportunity. So let me bring together what does it mean, what I explained before. Capital recycling, we said very clearly, these are the hurdle rates, beating the cost of capital the markets are requesting, creating value through any investment approach, and disposing at a price or even at a premium. We have been always in certain quarters delivering premiums to disposal. And this is how we recycle capital. On the financial discipline, always this goal of credit rating metrics. What does it mean? As a consequence, these loan-to-values, hurdle rates that, or boundaries that I shared before of you, and with this trend of deleveraging, thanks to this active management on the capital recycling, and as well on the operational side with this operational debt to EBITDA reaching this 10 times. And all these pillars, it's for shareholder return. All these pillars, keeping this balance, provides and delivers this solid FFO generation for all of you, and as well, of course, beating the cost of capital, additional value growth for the future. So for us, very important, and this is one of the main important things when we manage an investment committee and we manage our business, these three pillars are each one measurable, very important for us. You can measure these pillars, and very clear, and that provides accountability, which the reason why we are here. So all the output from this strategy is on the guidance. The result of this strategy at the end is the guidance. The guidance in short term, and we provide as well the guidance in this event about midterm. So the guidance, we confirm the guidance for 2026, 34, 35. As you know, we are going to propose to the AGM 32 cents per share on the dividend. And on the midterm, our guidance for the midterm, and Carlos then will provide the different building blocks, how we reach these numbers. We are in the range of 39.41, which is average 20% growth, which is remarkable. So all these three drivers, or the three drivers that we went through this morning, core portfolio growth, Alpha X deliveries, and capital recycling, all of them with a high visibility, with an active management and active execution as of today. So we feel comfortable of providing you these numbers. I would like to as well to emphasize that this guidance is grounded with the same financial discipline I explained in my presentation. So conservative assumptions, very secure numbers, and with a deleveraging trend, as I mentioned before. And finally, the DPS, which is the other part of the question, it's a mirror of the EPS growth. You can see here the trend of the DPS growing significantly, as well in line with the EPS growth. And how we envisage in the helix I showed before, in the framework of the three pillars interconnected themselves, the shareholder remuneration, you've seen that we have proposed, or we have executed already a share buyback, and we are going to propose in the EGM cancellation of 14.5 million shares When we approach our remuneration policy, in the first part, we have an EPS growth and DPS growth that provide this dividend growth policy. Of course, in the short term, you will see if the AGM approve, of course, and if you as an investor will approve the shares cancellation. And with this approach of financial framework, we have the scope of discretionary share buyback in the future. If we don't find good enough returns in the investment approach that I mentioned before, and this is why it makes sense, this discipline, then we have the opportunity to do share buybacks. If we have investment opportunities and we reach and we execute investment opportunities we had in the past at 90% IRR and leverage IRR, 10% IRR, of course we are creating more value investing at 19% and 10% IRR rather than doing share buybacks. Why? Because the share buybacks implicit IRR are below the hurdle rates that we are targeting in our capital recycling. So all it makes sense, and if we don't find or we don't see better returns enough to beat these hurdle rates or to fulfill these hurdle rates, of course we have a scope for these discretionary share buybacks additionally. So to close my presentation, I will give you probably some key message that I would like you take from my presentation. First message, it's about comfort on the balance sheet. I think you need to end this presentation about that we take care about the balance sheet. We take care of any metrics of the balance sheet, quality and quantity. So the balance sheet, investment grade, and does not mean only metrics, financial metrics, it means more things. And any single decisions, we analyze the 3 pillars that we envisage this comfort on our balance sheet. So the guardrails, we take care of them. And I think when you looked my first presentation, my first page, when you look our track record, you look growth and discipline. And this is why we manage and how we manage the company, growth and discipline. Second, conviction to growth. EPS guidance for this year, EPS guidance for 2028 with a clear high visibility on this growth in our business. And third, confidence on our framework. So the capital allocation approach is disciplined, measured, and transparent, and consistently being applied in the framework in the levels of the framework as I've shared before. And we, as management, always we believe that we have been delivering year by year through this profile of framework. The growth numbers are there, and the discipline rating is there. So thank you, and now I hand the word to Carlos. Thank you.
Okay. So, as you have seen this morning, we are in a segment that is a prime asset class that has superior growth across European gateway cities. We have the capabilities with the platform. Juanma and Alexia explained it. And not only that we have the capability, we have proven it. We have a track record, we have delivered the returns, we have delivered the cash flow growth. And all of this is embedded in a strong, solid capital allocation framework. Everything we buy follows a discipline. Everything we sell is being done in the framework of value creation and portfolio improvement. And we have everything that we do takes into account to have a well-grounded, strong capital structure in order to optimize the cost of capital of our shareholders. So with this in mind, we build our figures. And today, we're going to show you what we think, where we're going to land in 3 years from now, based on our business model that has proven to be very successful. Our business model has 3 pillars, as it has been already explained. Number 1 is our super prime footprint that really has above market rental growth. We are setting the standards in rents. Here you see some examples. Our assets set the standards. We set the reference rents, the highest rents in the market. In addition, and this is quite unique, I would say almost no company in Europe has really this capability, with a strong development track record. People in the real estate sector, listed sector, there are not so many people that really have this track record to transform assets. What does this mean specifically, looking into the next 3 years? We have 7 projects. 3 have just been delivered right now. 3 have just been delivered right now. This Magnum, Diagonal, and Hausmann, and they are progressing quite successfully. And then we have interesting phasing in across the next 2.5 to 3 years of 4 very attractive projects, all of them with large floor plates and with interesting urban mixed characteristics. And then we have a third layer that we've also proven to do very well, that is buying and selling, improving the average return of our portfolio and remaining with a strong balance sheet. We announced a disposal program in November. It's just a few months ago. As of today, it's accelerating both in timing and in pricing. We are getting higher prices than we expected, and this has encouraged us to enhance further the disposal activity and to add on top 200 million. But we're going to also deploy capital. Our idea and what we have baked into the numbers that we show right now is that we use roughly 0.2 billion into new things. One is the buyback program that has already been completed, and then some investment opportunities that we are quite close to execute. So, first of all, in terms of modeling, how should you factor this in? The first layer, it's an ongoing layer throughout the 3 years. The prime operations. Maybe a little bit of distinctive elements is in Barcelona we have especially a driver of occupancy ramp-up. Barcelona is accelerating. The market activity is gaining a lot of positive traction. So this is really an interesting engine of additional cash flow growth. Madrid, we have a portfolio that is at very high occupancy levels. So we have there a lot of rent reversion from top assets, and also here and there some opportunities of letting up. And Paris is similar to Madrid, but it's really a very strong market with our assets have there an extremely strong pricing power. And then we have something in addition to Barcelona as a consequence of the longer contract maturity structure of the city. We have a significant reversionary potential in passing rents as of today. It's quite important number. On the project, as I said, 3 of them are delivered. They have almost not contributed a lot of rents in 2025 because they were delivered across 2025, and they will now kick in across 2026 with interesting numbers of rents. And then progressively, the urban business campus at Gare de Lyon scope will kick in towards the end of the year. Then towards the end of 2027, Condorcet and Sancho Ávila. Sancho Ávila today is already fully let, so there's no commercial risk. We have the rents already in-house. It's just an issue of timing. And then mid to end 2028, the student housing premise Santa Hortensia. On the disposal program, it's ongoing. We are starting now to identify new opportunities. We've seen a lot of things that can be value attractive in a disposal program, and the buyback program, as all of you know, is completed, and on the prime acquisitions, we are currently working on it. If we go a little bit into the details, the first layer, our best estimate as of today is that it will add 5 to 6 euro cents per share. Implicitly, this is a CAGR growth of 4 to 5% in net rents. As I said, the drivers are a little bit different in every city. Barcelona is a strong occupancy ramp-up driven. Madrid is a combination. Paris has also really spread. There are some assets that stand out. Louvre de Bureau has a very interesting growth portfolio. Then also Recoletos and Velázquez, as they are very strong assets with strong pricing power, have an interesting profile. Then there's some ramp-up in Visionary and Santa Gracia. So there are a variety of different assets where we can capture additional cash flow. Then we have the project pipeline. You have, on the one hand side, the delivered assets, and then we have the 4 Project Alpha X assets that will kick in. Our best estimate is that as of 2028, we will have 80 million of annualized rents. As of today, we are at 8 million. You know that in the presentations, we always flag these 7 assets with a full capacity of 100 million. As Condorcet and Santa Hortensia and Sancho Ávila are kicking in more at the back end of this timeline, we get at the full capacity at 2030. At the 100 million are being achieved in 2030, but in 2028, we expect to be at 80 million. The remaining capex, you see it here, 148 in 2026, between 100 and 120 in 2027. These are the most updated figures, including all of the uncertainties that have been also not currently in the short-term situation. And we have 20 million that were already invested in Q1. So in terms of pending capex as of today, between 248 and 268. All of this, and here you see, as we always said, it's a quite relevant growth driver, 8 to 9 cents per share at full capacity. That is more 2030, 11 cents per share. And then we also create value by capital allocation, by rotation. So we are selling off assets and we are redeploying the capital. As of today, we expect to have a marginal impact of value creation in terms of EPS, recurring EPS, or recurring cash flow of 2 to 3 cents. What is included here is the impact of the share buyback program, the investments that we are looking at that has an ungeared IRR in excess of 8%, and also the contribution of the activity that we are doing in terms of third-party capital management, so cash flow from asset management that we are collecting. All of this together, we estimate as of today that it could be between 2 and 3 cents per share. So when we look at all of it together, at the starting point on 2025, we were at 33 cents a share. We expect, with our business model that relies on 3 value drivers, to add another 15 to 18 cents. 5 to 6 from our core activity, from the strong cash flow of our assets. As I said, a CAGR between 4 and 5%, as you see, 200 to 300 basis points above indexation. Then a very significant driver, this is why we have done this many, many years, because we have the capacity to do it successful, is urban transformation, its projects, 8 to 9 cents per share. And then capital recycling, we are in the business of constantly improving the average return of our portfolio, 2 to 3 cents per share. So together 15 to 18, that in an environment that everybody knows where we are still in a situation of increasing interest rates, more than offsets the impact from interest rates. So a very healthy and solid cash flow growth and embedded in a disciplined and strong capital structure. From point to point, this is between 16 and 22% and 5 to 7% CAGR. This is by far, as of today, one of the highest or maybe the highest growth profile in the European listed sector at the moment. So this is at the end the proposition. And as you can see, we are confident on it. It has been built with a lot of detail and with a solid and disciplined capital allocation framework. And when you look at the last 10 to 15 years, these are the growth rates that we have always delivered. So we are quite confident on it, and that's why we decided also to flag it today and to explain where it comes from in the different building blocks. And we decided to do the final wrap-up of the session.
Thank you, Carlos. I think that we are not only late, but ahead of time. So this was not planned, to be so on time, but it's fantastic, So this last section, it's a little bit of a wrap-up of everything that has been said, a little bit of maybe additional deep dive on certain things, that maybe need an additional layer of comments that have to be provided, and the final takeaways that we expect from this meeting today. The ideas. Coming back to the very beginning of this session this morning, there's something going on in our market that is good, that offers growth, and that offers an opportunity. It's not only about Colonial. It's about what's happening in urban cities, what's happening in the office market. There is a clear trend towards polarization. There is a chronic supply of the right product for this polarization. This is on balance versus the take-up that is surging in Europe in the search of these trophy assets. This creates a number of dynamics that create, let's call it a beta, a kind of external growth factor that are driving our sector, and that explains why the performance is being a good one so far, but moreover, why do we expect this performance to remain even better in the future. And the second part of this story is, well, this may happen in the market, but we happen to be very well positioned. We've been strategically committed to this positioning for a long time. That has already generated a number of returns, but today that is transforming Colonial into the prime dominant player, the dominant player in prime assets. And we have this positioning with an unparalleled track record, having been able to deliver this in an international footprint, and with also the additional layer of capability to generate returns through capital recycling and development of new projects. I like this slide. This is it's just now. I think that these numbers is recently, but if you could take them for the next recent years, it's about like-for-like growth versus exposure to prime. No? This is a plot that I asked for the most recent data available, but this could apply for recent years, and we believe that this will apply for the next years. We want to be in the range of the highest GRI like-for-like growth that will explain the superior returns of Colonial going forward. And this, and we insist, is something that it's not about wishful thinking from now on. This is a vision of returns, the leverage, and everything else in the last 10 years. In the end, the history of Colonial in the last 10 years is about a history of sound growth with good discipline in terms of leverage. It's a good equilibrium between growth and leverage that has been delivered consistently and that has led us to where we are today. So these are the foundations of where we are in order to project ourselves into the future. How do we project ourselves into the future? Well, this slide is a slide that you should never do. Too many things explained in one slide, but I will try to walk you through this, because in the end, it's a summary of everything that has been said today. If we project Colonial in the next future, first of all, a framework. Here there is a triangle of wanting to invest in the best places with the higher returns possible, with discipline. I said before, if we missed it, we missed it. We've lost a couple of opportunities in Paris, but it's important that we remain disciplined in our hurdle rates that we want for our investments. This is an angle, but this is dependent on the prime financial structure that we want to achieve. And this is within a model that in the end is to generate the EPS and DPS and in the end shareholder remuneration that we want for our shareholders in the future. The returns we want to give for our shareholders in the future are based on prime CBD operations, on Alpha X, on capital recycling. Just to summarize where this is coming from, I think we just saw from Carlos' presentation very clear numbers attached to this, but I think that the strength on prime CBD operations is clear. I won't insist on this. We had a debate yesterday. We had pages and pages of evidence of superior returns in the last few years. In the end, we sent them to the appendix of the presentation because we thought we would be boring you. We just included a couple one, but there's a number of evidences. Prime Factory Alpha X, remarks. We have those 4 projects. There were 5, but you're sitting today in the number 1 of these 5, already done, delivered. Here is the product. Here are the returns, the value created. They are the 4 remaining ones. Here, to emphasize this, let's say, flexibility in terms of our commitment to Prime Factory, to creating a prime product within a wider scope of looking at urban transformation opportunities. So you see that out of these 4 opportunities, 2 are not going to be office buildings. One is a hospital project in Barcelona. It's interesting. It was the first office building that was built in the 22 Art neighborhood in Barcelona, the T Systems headquarters in Barcelona. This area of Barcelona, it's super clear that it's on balance between office supply and other users. It needs desperately a hospital. it's not us who are saying this, no? The town hall is chasing Albert all of the time because they are so much interested in this project. Of course, the operator that is renting this for us is a super believer, and the returns are much better, no? So that's why we are delivering this project. The second one that is, and this one will be delivered next year, and next year we'll be saying, as we are now saying from Magnum, this is done, no? The next one, maybe it's a little more tricky, is the student accommodation one, Santa Hortensia. So the story of Santa Hortensia was, we expected that with the new evolution of IBM, no, the way the company has been restructured, this would have the opportunity to go in different directions. When we bought it many years ago, we already had all of these, no, kind of stress test scenarios. We went through the initial analysis. It was crystal clear that there was a better use for other users, non-office related, no, that had a higher value. Anything related to residential is offering today an opportunity, if possible, because it's not so easy, in different European cities, but in Madrid it's a clear example. By doing transformation, you achieve additional returns. We had a look at different alternatives. Let's call it traditional residential did not work out because of too much time attached to the project, but short-term resi, which is living, flex living, hospitality, student accommodation, anything work out pretty well, no? So we decided to go into the student accommodation direction. Why? Because so much pressure from all operators, from everybody in the market, looking at very much interest in this. By the way, we keep the optionality of this coming back to ordinary flex living or other areas of flexibility, of hospitality, if market trends give us this advice, no? It's to transform a student accommodation into ordinary flex living. It's very easy in terms of CapEx requirements, no? So let's not forget about this optionality, because as you know, flex living is also booming, no? In Madrid, no? Of course, every time that we approach something that is not office, we carefully assess all of the risk attached to that, and that meant here selecting an operating partner that came with us. We went through the interest of many different people, and we finally selected one, which unfortunately we are in quite advanced stages of discussions, but still not at the time that we can be transparent, pity, but that's how business happens. But we are very well advanced. And so in this particular area, what you should be seeing in the future is that we announce at some point a partnership to manage this project, which will bring comfort on, let's say, the proper management of the opportunity. We are considering going a little bit step beyond, and that is to create together with a partner a platform. I was going to say a small platform, but it won't be small, of our asset plus other assets, no, in this universe of this partnership. Basically, and I'm saying this because maybe this will be disclosed, no, in the near future. The rationale behind this is that we are enhancing the value of what we have, no? So today we have a development that is promising fantastic returns 3 years from now, but it's a development and that's it, no? If we contribute this to a platform, we will be transforming this into a share of a portfolio that is cash flow producing sooner, that has a more dominant position in terms of operations, in terms of competing, where we have already crystallized the expected value that we have for 2028 of our building. So we are de-risking the development. introducing cash sooner, having more value. So that's why we may be going in this direction. Does this mean that we are, let's say, revisiting the strategy of Colonial? I think that today we wanted to pass the message to you that we are pretty focused on what we do, and that is pretty consistent with maximizing value for every asset we own, and we are not shy, and we are ambitious in the way we do it for every asset. And sometimes we may give the wrong perception. I remember when we did the residential here, the one you passed through. Wasn't this a wise decision? We did it. It just created a much better environment. We did it. We sold it. By the way, today we announced that we are quite advanced in the residential in Spain that was contributed from Criteria 2 years ago. I remember a little bit of hesitation about what does this mean. I think that I would like to pass a message of comfort to be an office player at the heart of your business, together with maximizing value through urban transformation, is something that is consistent and it's in the benefit of shareholders, and that's why we are here. So this is the comments on Alpha X. So 2 will be or are currently urban transformation projects. The other 2 will be traditional prime factory initiatives. And on capital recycling, the message is clear. Divestments are going quite well, as you can see, much better than disclosed before, I would be honest, than expected. So when we decided to go retail in the process of selling residential, we were right. We are achieving much higher premiums and much quicker than expected. So the $500 million divestment program, it's been a success, honestly. Based on that, we are flagging the additional 201. And on the investment side, the 200, yes, the message is you will probably see us investing in Germany if things go the way they are. It will be prudent because we are talking below 200 million framework. It will be prime. If it's not prime, it won't happen. Let's put it this way. It's not as usual. It's not passive ownership of a beautiful asset. It's because we have identified things that we would like to do with these assets, in due course. So we will have an initial profitability, let's say, expected, which is higher than what we usually are used to in France or in Spain. And on top of that, we'll have a little bit of real estate rationale attached to that will bring us additional layers of returns in due course. It will probably be again through a partnership. This is another question that we put to us. Are you comfortable doing things here and there? And look, the story of Paris, it's been 20 years of international, let's say, exposure. By the way, urban transformation, the Mandarin, it was 15 years ago, 10, 12 years ago. Message of comfort. We do this on a regular basis. So you will see a little bit of this capital recycling happening this way, but most of all within this framework that you have repeatedly been explaining today. All of this in a context of wisely managing investments versus deleveraging versus share buybacks. I think that Carmina explained that very well. So we constantly look for investment opportunities. We are strict about the hurdle rate and the return we want to achieve. If it's out there, fantastic. If it's not there, okay. We also want this to be on a condition precedent of prime financial structure, which today means additional deleveraging. So first goes the capital structure, then later goes the investment decisions. And that means also a context of capital recycling, selling and buying. And that's basically the framework that we expect regarding capital structure. I think that the idea today was to pass you the message that we pretend to have a sophisticated approach to financing decisions. In the end, it's about minimizing our average cost of capital, and I think you have seen what is the cost of capital that comes from this capital structure decision today. It's not. We do have a prudent capital structure. We also manage, I think, as many other companies, interest rates with prudency, meaning hedging policies, as everybody else, or not everybody else, as many companies. And on top of that, we were, if you want, lucky or wise to take some decisions a few years ago that generated value for shareholders for several hundred million euros. At the beginning, more than 400 million euros now. Yeah? And this can be recognized in different ways. We follow strict IFRS rules, as I think anyone should do. But you can look at this in many different ways, but the value is there. And these are good news, the fact that value has been generated. How do you look at it and how it is recognized? I think it's second level debate. The first one is value has been generated. No? But anyway, as Carmina explained, our deleveraging process, it means that we are at the low end of the frame that is considered by S&P for our current rating. On top of that, with our current business plan, our expectations is that this LTV with current market circumstances will go down between 150 and 250 basis points additional for this kind of midterm, let's say, a scenario that we predict. So I think, and last but not least, and also Carmina said it is very important, without compromising earnings growth. I think that any company, it's about the sound equilibrium of earnings growth with leveraging, the leverage or discipline decision. So this is the framework of what we want to do going forward. Since this may seem very theoretical, the objective for today was to translate this into numbers. And this is a kind of summary of the business plan that we use internally to work, the management of Colonial and SFL. We have a, let's say, sophisticated and detailed business plan in order to frame any decisions. We look at everything from an industrial point of view. I said at the beginning that it's nice to have these opportunities to talk, because as you can imagine, everything we do, we cannot do it looking at the impact during this year on EPS or during this year on the balance sheet. This would not be sound management. We do it looking at a 5-year period or a much longer even year period. To pass a message today, this is, well, in fact, Carlos went through this. This is the translation of everything we are expecting to do in the next 3 years. And this means that we should see our EPS in the range of 39 to 41 by 2028, which means an annual total return between 11 and 13% as a combination of the EPS yield and the growth. And you can look at this also from looking just at dividend yield plus the growth. Maybe it's a side comment that is maybe good to have, or maybe not so much, but yes, we were told, please, let's remind the audience that we, the management, have skin in the game. and that this matters to us, no? And I can tell you it matters, no? I can tell you because if you want to be very, let's say, very basic about this, our remuneration is biased towards variable remuneration as opposed to fixed remuneration in a comparison with a benchmark. And in this, let's say, variable part of our remuneration, it's biased towards total shareholder return for shareholders above peers, above the benchmark. No? So we are on the same boat. That's what I wanted to say with you. It's not that we want to please you with this, and then we come to our ordinary life. No, our ordinary life is about to deliver. Sorry, not for you, but for us, or not only for you, but for us too. So this is basically what I wanted to share today. Now we will have, for those of you who are sharing this place with us today, the opportunity to questions, debate, for anything that needs more, let's say, deep dive. But I think, as I said at the beginning, it's been a pleasure to have this opportunity. At the beginning, I mentioned, well, these are the takeaways that we would like. You always have to even more simplify, no? For me, the takeaway is, well, that we have a good strategic positioning, but more importantly, that this company is offering clear visibility on mid-term growth. In the end, that's what we wanted to share with you today. Our daily life, when we interact with capital markets, sadly is too much focus in what's happening in the next few weeks or months or within the year. For me, capital market is about having the opportunity to look beyond. So for me, the main takeaway is clear visibility on mid-term growth. And because of everything that's happening, all of this within a framework of disciplined capital allocation. So we also wanted to pass the message of not only the how much, but also the message of how are we managing this company. That's it. So thank you. And just now in a few minutes we'll start the second part, like debate or Q&A. Thank you.